U.S. Treasury bonds are back in focus as interest rates stay elevated. Investors are looking to enhance yield without taking on massive risk. Today we're breaking down 4 ETFs centered around long-term treasuries: TLT, TLTP, TLTW, and TLTI. Now what exactly is TLT? Well, TLT is the iShares 20+ year Treasury bond ETF. This is the core long-duration Treasury bond ETF from iShares. It tracks the U.S. Treasury 20+ year bond index. So it's giving you exposure to long-term U.S. Treasury bonds, and it has targeted access to a specific segment of the U.S. Treasury market. So this is pure exposure to long-term treasuries. No option strategy is used on this ETF. It is fixed income. Because it's tracking the U.S. Treasury bond index, this ETF is extremely interest rate sensitive. It performs well when interest rates fall. And based on the 5-year chart, we can clearly see that when interest rates were near zero, we were at an all-time high of around $170, and interest rates have been increasing over the past 5 years, and we're at all-time highs for these interest rates. So this is a great time to buy U.S. Treasury bonds, because when interest rates do end up falling, this ETF is going to see some pretty significant returns. But with those high interest rates, we also see a very high dividend yield of 4.31% because we have direct exposure to these US Treasury bonds. And the best thing about it is we are paid out monthly. So for people looking for some extra cash flow, a safer place to park your money, TLT has been a great option for many investors. But keep in mind, TLT is best used as a hedge or a rate play. It is not ideal for income seekers. Because this doesn't generate high income, the yield is based solely on treasury payouts. Think of this ETF as a way to beat inflation. But what exactly is the 20+ year treasury bond? Well, the 20+ year treasury bond refers to a US Treasury bond with a remaining maturity of more than 20 years. So while you can go to the government website and buy these treasury bonds directly, it is much easier for a lot of people to just simply buy this ETF, TLT, which tracks that index. If you do end up buying the actual treasury bonds, your money is not tied up for 20 years. You can sell those bonds whenever on the market, so your money is not completely tied up. Now let's go over 3 ETFs that are based off of TLT and provide option income. First one is going to be TLTP, which is the Amplified Bloomberg US Treasury 12% Premium Income ETF. Now this has been a popular ETF as of lately. There are 3 reasons here that you can own TLTP ETF. The first one is going to be targeted income. So this ETF is going to target an annualized option premium income of 12%, with the potential for additional US Treasury bond income. And the second reason is going to be risk mitigation. Weekly covered call options can help mitigate risk by providing additional income in volatile markets. And of course, we have convenient access. Provides simple, efficient entry to a tailored US Treasury option strategy via a single ticker. So we saw with TLT that it was very simplified. You can just easily buy into the Treasury bonds by buying TLT. Now, if you want to take it a step further, you can buy TLTP, which employs an options strategy by selling covered calls off of TLT to generate even more income. And because this is an actively managed ETF, we're going to be paying an expense ratio of 0.38%. And of course, because it's employing the option strategy, we're going to be having a distribution rate of around 12%. And that is going to be paid out monthly. All these ETFs are going to be paying out monthly, and this is pretty good for people who are looking for some additional income. But keep in mind that TLTP is a fairly new ETF. It was just released in October of 2024, and the share price, it has been depreciating about 7.55%. Now the third ETF is going to be the TLTI, which is the NEOS Enhanced Income 20+ year Treasury Bond ETF. Now TLTI invests in long-term treasuries such as TLT, but it doesn't write call options on TLT like the other 2 ETFs. Instead, it overlays a put spread strategy on the S&P 500 index, SPX, and it sells SPX puts and buys puts further out of the money. And this is going to help with the goal of creating a higher distribution rate than normal TLT. So we're going to be seeing a 6% distribution rate distributed monthly because of this option strategy. And if we take a look at the holdings, we can see it does just that. We have the 20+ year Treasury bond right here, and then we have a bunch of put options both sold and written, and that is going to help generate additional income and provide that 6% dividend yield, which is about 2% higher than TLT. And we do want to note that it does incorporate tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which basically means you're getting taxed at a lower rate. So this is a unique approach to TLT and employing an option strategy because we're not directly selling covered calls on TLT. And if we take a look at the all-time chart, we're actually down 7%. Many of these ETFs are down, but we do have to take into account that the overall market is down and we are receiving dividends. So we're going to go over the total returns of all 4 of these ETFs later. But this is a very new ETF. It was just released in December of 2024, so there's not much history on it, but the strategy underlying does feel very promising, so we'll have to keep a close eye on this ETF and see how it does. But so far it's paid out 4 dividends, and I know a lot of people who are holding this ETF have been pretty satisfied so far, especially since all 3 and 4 of these TLT ETFs have outperformed the S&P 500 index, and it's a great option to hedge your portfolio during volatile markets. Now let's compare all 4 of these ETFs and see how they have performed. So year-to-date return, we can see that TLTW has actually outperformed the other 4 ETFs. It is actually down almost pretty much break even, 0.04%. And the ETF that is down the most is actually that NEOS Enhanced 20+ year Treasury bond ETF, and that is because you're getting exposure to the S&P 500 through those put options. But we can see they all have pretty similar exposure and pretty similar performance to one another. But which one really is the best? It's very hard to tell. Of course, we have TLT with an overall return of -6%. We have TLTI, -6.84%. TLTP, -6.22%. And TLTW, -3.97%. So based off of this, the clear winner is TLTW, which actually has a higher history of paying its dividends because that ETF was created in 2022. It has more of a history, it's a little more established, and a lot of people have been pretty satisfied with that ETF. But of course, TLT is the tried and true ETF, paying a dividend yield of 4.31% currently, and it has the most volume compared to all these other ETFs. The volume right now is at 44 million. So comparing all 4 ETFs, if you want pure treasury exposure, no income enhancement, simple TLT is going to be your best bet. Now, if you want the highest income potential with aggressive weekly calls, TLTP is going to be your bet. Now, if you want moderate income and a more conservative call writing strategy, TLTW is going to provide you that income. Now, however, if you're willing to take a little bit of a risk, TLTI, which is the NEOS Enhanced Income 20+ year Treasury Bond ETF, it is going to give you creative income via the SPX put spreads, and it's best for tax-sensitive investors. So you want to invest in TLT if you want interest rate risk only and you're looking to hedge or position for falling rates. Now, rates have been very high for quite some time now, so a lot of people are anticipating within the next year or so that rates will have to come down. They can't stay high forever, and in that case, it's going to reward you heavily when rates do fall with great ETF and stock appreciation. Now, if you're looking for maximum income and don't mind the short-term swings, TLTP is going to be a great ETF for that additional income as well as volatility. And of course, we have TLTW, which has been the highest performer, and it's going to be a balanced approach to income with reduced risk. You do have to keep in mind that even though this chart looks pretty scary, the dividend yield makes up for it, and if you reinvest those dividends back into the ETF, you're going to be seeing some pretty great returns. And if you're looking for something more tax efficient and a smoother equity volatility based ride, TLTI is going to be a unique pick for your portfolio. So these new strategies make boring bonds exciting again. TLT is no longer just a hedge, but it's now the foundation for creative income. TLTI, TLTP, and TLTW offer investors options, literally. So pick the one based on your needs, your risk, your comfort, and your time horizon.